Okay, welcome to the June 28th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about fats and greases, UCO and yellow grease more specifically, and then we'll do our usual review of what's going on in the renewable fuels market with regard to profitability and credit prices. So the biggest feature over the last couple of weeks has actually been in veg oils, with prices falling pretty sharply. It seems like we probably have found a bottom here. I think that the part of the reason that prices had come down was a decline in energy prices and concerns about a looming recession due to the Fed's efforts to combat inflation. And it seems like that took energy prices down. Now, with China relaxing COVID restrictions, it seems like energy prices and I guess also talks about new potential bans or tightening of the restrictions on Russian oil trade. That seems to have turned the energy market back around and helped soybean oil find a bottom. I think it also helped palm oil. And like I sort of explained last week, I think palm oil was really sort of the driver of the decline in vegetable oils. And so a 500 ringgit rally in palm oil has also helped to stabilize soybean oil prices. All of that has not had much of an impact on fat and grease prices for the most part. Other than DCO, fat and grease prices have remained relatively steady or even risen a little bit. I think that, I guess I'll say it this way. There's going to come a point where, based on the growth in renewable diesel usage, that the demand for fats and greases, it sort of exceeds the available supply. We may already be at that point, and I think the price action would suggest that we are. Historically, what you've seen is fat and grease prices react to movements in vegetable oil prices with a lag that varies between sort of 3 or 4 and sort of 6 weeks. And so while the plunge in vegetable oil prices is still relatively before that window, it was sharp enough that if you look at the relative profitability of feedstocks, soybean oil became sort of more profitable for biodiesel and renewable diesel production than most of the fats and greases, bar UCO and yellow grease. And so I think that certainly fat and grease prices could come down, and on some level, if soybean oil stays down at 60 cents or drops below 60 cents, they will need to come down to work their way back into the feedstock mix. But it may be that this idea that we're using up as much fat and grease as we possibly can may mean that the prices are sort of pinned at or near historical highs. And at least right now, the evidence would suggest that that is the situation that we're in. If you look at a lot of the fat and grease prices, and I'll just pick out UCO and yellow grease because those are the two that I happen to look at to get ready for this week's webinar, those prices have been steady for at least 4 weeks and in some cases longer than that, 6 weeks. The one exception in the UCO market is UCO in Southern California, which jumped up a couple of weeks ago, but still relative to the moves that we've seen or the volatility that we've seen in the vegetable oil markets, it's been really, really stable. And I think that there's a chance that what that means is this is sort of the ceiling for those prices. Above those prices, the renewable diesel industry isn't interested, and to get below those prices, you would need to decrease demand, which the renewable diesel industry really kind of also isn't interested in, because everybody wants to use fats and greases to reduce their CI scores for the LCFS market. I think it will be telling to see the movement in fat and grease prices over the next several weeks. If prices remain stable at current levels, then I think the evidence that we're sort of at this point where demand is so strong that there isn't any additional available supply left, it gets a little bit stronger. If we follow the typical historical pattern and prices start to come down and the fats and greases get more competitive relative to soybean oil, then I think that there's probably some room left for additional demand from the renewable fuel industry. It's a little tough to tell. Like in theory, I should be able to tell whether we're at that point or not from the fundamental supply and demand data. The problem with doing it that way is sort of twofold. One, the data that comes out for fats and greases, the supply and demand data that the USDA provides, while very helpful, isn't necessarily something that I think of as accurate as I do or as reliable as I do for soybean oil. Not that it's not reliable and not that there's anything that's really better. But for example, for UCO and yellow grease, we essentially estimate UCO production and yellow grease production, and the same for ending stocks. So one, you have a little bit of a problem with the data quality, although that in and of itself, I don't think would be enough to suggest that we can't figure this situation out because of the data fidelity. The second and probably more important reason is that we divide domestic usage into biofuel usage and then non-biofuel usage. We get a biofuel estimate from the EIA, and then the non-biofuel number really comes down to a residual number. So basically, take all of the supply, subtract the biofuel demand and export demand and ending stocks, and then whatever's left over we assume is non-biofuel usage. Well, in some cases, that series is very volatile, which makes you think that it's probably not entirely super accurate, because you wouldn't think that that the demand for these things swings by that much from month to month. And in some cases, in UCO in particular, you can even get negative numbers for residual usage. Now, there's a couple of explanations that I think might make sense for this. It may be that that there's some portion of UCO production or estimate of UCO production that is kind of classified as UCO, doesn't get used as in the biofuel industry, and then sort of goes back into yellow grease. And so things like that can start to mess around with the residual usage. There's another reason that UCO could put up negative non-biodiesel production or usage, and that is because our production estimate is off. And so I also wanted to talk a little bit about how we estimate our UCO production and some changes that we're making to the way that we estimate UCO production, and why you might see numbers shift around for UCO a little bit while we're sort of trying to figure this out. So historically, what we've done is taken the USDA number for yellow grease production and stocks. We've divided it up between UCO and yellow grease. But if you just do that based on the numbers that we get for exports and for biomass-based diesel demand, it doesn't necessarily work out. So what we do is then we adjust the USDA numbers by a series that USDA also publishes, which is the spending on food at home and food away from home. We have in the past used the non-inflation adjusted spending to estimate UCO production, and that didn't really matter when inflation was at 0. But when inflation is at 7 or 8%, then you're going to get some theoretical growth in UCO production that's not really there. That's just, there's an increase in spending because stuff costs more, not because we're actually using greater volumes of or consuming greater volumes of food, and so producing more UCO. So we've changed from the non-inflation adjusted spending to inflation adjusted spending, and we've played around with this a little bit, and there are sort of two paths that we can go down. There's one that sort of has UCO production really high and suggests that that residual usage is never negative, and in fact can be pretty substantial, can be sort of 1 billion pounds a year or something like that. And then there's another where UCO production is just above or very close to the level that takes non-biodiesel production or non-biodiesel consumption close to or into negative territory. I think there are strengths and weaknesses to both approaches, and to be really honest about it, we still haven't decided exactly which way we're going to go. Currently, we're leaning more towards the make production so that non-biofuel usage is very close to 0, and I think that's probably where we're going to end up. But because of that level of uncertainty between sort of 0 non-biofuel usage and 1 billion pounds a year of non-biofuel usage, it's very hard from an overall fats and greases perspective to say that, oh, we're at the level where renewable fuels feedstock demand is absolutely maxing out supply, and because of that, prices can't decline from their current levels. Again, I think we'll know more about where we are based on the price action over the next several weeks. And I think depending on exactly where prices go over the next several weeks, probably will be the final thing that makes us shift either towards one of the two pathways that I've kind of described here. Unfortunately, it's not as easy as just sort of relying on USDA data like it is for the vegetable oils, and we have to make some estimates in a couple of places. The other is DCO, where USDA puts out a couple of corn oil supply and demand tables, and they have a hard time reconciling with themselves. And so we also estimate our DCO production based on ethanol production and some assumption about the yield of DCO per gallon of ethanol produced. Again, that's another reason why it's difficult to say with complete certainty that, hey, we've already reached this level where feedstock demand is taking up all of the available supply of fats and greases. Whether we're there at this point or not is important for the short-term price outlook. It's less important for the long-term price outlook, in part because I think that we are going to get to that level at some point, probably within the next year, if it even takes us that long, given the expected increase in renewable diesel capacity and the fixed level of production for fats and greases. That's just something that's going to happen. Now, there are other substantial sources of demand for fats and greases, there's feed demand, and there's also oleochemical usage that that aren't going to go away. And so there's always going to be some non-biofuel usage, but we also don't get data for any of those sources. And so while we've made some estimates over the years on what we think those are, again, those estimates might be off, and we may have 1 billion pounds a year of additional supply right now, and we may have 0 pounds a year of additional supply right now. And again, that's why I go back to relying on what prices are doing to tell me where I think this level is, and why this recent decline in soybean oil prices is so important as an indicator of where we are in that process, and whether we've reached that point or not yet. All right, so let's take a look at our expectation for this is for yellow grease, and you can see we expect prices to kind of remain at these levels or move up a little bit. Again, on some level, the way that we forecast prices is based in part on the supply and demand fundamentals for each individual commodity, but then also we look at the spreads between individual commodities. And so part of the volatility that you see here is due to the volatility in soybean oil prices and what we expect soybean oil prices to do, and the spread between yellow grease or UCO or any of the fats and greases in soybean oil prices to do. In general, I think that what we expect is that those spreads probably will be a little bit wider than they have been historically, or a little narrower, I guess, than they have been historically. UCO is going to look pretty similar, a little bit steadier, but with an increase in the end of the year. And what's really driving this increase at the end of the year is the typical seasonal increase that we get in biomass-based diesel production as obligated parties try to get generate enough RINs to meet their obligations. This year, like we've talked about before, the gap between what the biomass, the level of production for biomass-based diesel that's implied by the mandates, and the level that's likely to take place to meet both the undifferentiated advanced mandate, which is the D5 mandate minus D5, D4, and D3 production, and Brazilian ethanol imports, that gap, and then also plus the gap between the ethanol mandate plus the supplemental mandate and what we expect ethanol production to be. Because of that, the demand for fats and greases and fat and grease prices may really explode in December, and that's semi-reflected here. My only caveat to this forecast would be that if somebody told me that my forecast was going to be wrong and I had to choose whether it was going to be, I expected it to be higher or lower than my current price forecast, I would say that the risk is probably much greater that prices would be higher than my current forecast rather than lower. And again, that's because even if we're not at this level where all of the additional feedstock demand, or all of the feedstock demand is taking up the additional available supply, if we're going to really ramp up production in December to meet the RVOs, then there's probably going to be even more strain on fat and grease supply. And that's the time when prices can really move to levels that it's very hard to predict and that people never really expect them to get to. All of that said, given the recent history and what we've seen, I would expect in the short term there's maybe a little bit more downside risk to my price outlook for fats and greases than there is upside, just because of the move in soybean oil. Now, if soybean oil goes back to 70 or 75 cents in the next week, then maybe fat and grease prices don't need to move that much at all. I don't know that I really expect soybean oil to get back to that level that quickly, although I do think that soybean oil probably, at least in the short term, has set a bottom. And I think that bottom is probably relatively close to what we expect the long-term equilibrium for soybean oil prices to be over the next year or 2 years or something like that, if you just kind of took an average price. But again, I still think that the risk to that outlook is probably to the upside, especially if you have a continuation of the war in Ukraine limiting supplies of sunflower oil out of the Black Sea region, any production shortfalls in the US this summer, and then again, any production shortfalls in South America next during their summer, our winter. All right, let's talk a little bit about what we saw in biodiesel. This week, just generally this week, we'll get the EIA monthly report for renewable fuel production, excluding ethanol. You can see that we expect it to tick up a little bit from March to April. It's a couple months in the rearview mirror. We've already gotten the EPA data, so this isn't the most important data point that ever comes out. But given the fact that we can match up the feedstock demand against this series, or part of the series in theory anyway, it does provide some useful information on what we think sort of the average yield for renewable fuel production is. That assumes there's a bunch of assumptions that go into that, but as a general guide, it can be a little bit helpful. Outside of that, mostly it's useful to compare against itself and show the growth in domestic renewable diesel production. All right, on to gross margins. All right, so this week we saw a huge pop in renewable diesel or biodiesel margins, which for some reason, why does this chart never show up right? Biodiesel margins by the spreadsheet went up to 54 cents a gallon, which is the highest level that they've been in this data series, which started in 2019. Bob Lane, one of my colleagues, he's tracked biodiesel margins for a little while longer, so since 2017. He said that last week that he thought margins rose to the highest level that he had seen in his series since 2017. I would suggest that there was a period in 2014 when energy prices were close to current levels, and soybean oil prices were significantly lower. Profitability may have been greater then, although of course RIN prices weren't as high, and so you'd have to go back and really do the calculation to figure that out. But certainly biodiesel margins have been are about as high as they've been maybe ever, and certainly in a long time. Our feedstock assumptions, which are for biodiesel 75% soybean oil and 25% yellow grease, and for renewable diesel, which are 50% bleachable fancy tallow, 25% UCO, and 25% DCO, again, then tend to reflect sort of as much as they reflect the profitability of biodiesel versus renewable diesel, they also tend to reflect the profitability of vegetable oils versus fats and greases. And so you can think of biodiesel as a reflection on the trend in profitability before biodiesel and renewable diesel facilities using soybean oil as a feedstock, and renewable diesel as the trend in renewable diesel profitability is an indication of both renewable diesel and biodiesel facilities using fats and greases as a feedstock. Renewable diesel margins declined just sort of slightly, and that was because the difference in the two margins was really because for biodiesel, soybean oil prices fell sharply. For renewable diesel, you did have a decline in DCO, but everything else stayed steady. And I think tallow prices actually went up a little bit as well. And so all of that kind of basically offset itself, and you had basically steady renewable diesel prices or profitability. We expect that biodiesel profitability will remain pretty well supported through the end of the year, not quite at current levels. We think it probably slowly moves lower, and by the end of the year, it's back down to below 20 cents a gallon, something like that. And we would expect it to remain positive through the end of 2023, just because you still have the supplemental mandate, and given the changes that the Biden administration made between the preliminary RVOs for 2022 and the final RVOs for 2022, I think that they've indicated that they're not interested in changing the ethanol mandate. So that probably means that there will be another big gap next year. And as a result, there will need to be more renewable diesel and more biodiesel production next year to fill the undifferentiated advance gap, and then the gap between ethanol production and the ethanol mandate. The one variable for next year, and part of the reason that we think that biodiesel margins sort of slowly decline, is of course the increase in renewable diesel capacity, and that probably will continue to pressure biodiesel margins. Right now, it looks like there is enough additional demand that the growth in renewable diesel capacity probably isn't sufficient to completely take biodiesel margins back negative and really start to force rationalization of biodiesel capacity. But we're going to have to see the exact timing of all of the new facilities when they come online, and how many of the new facilities actually do come online. Between now and 2022 and 2023, we should get most of the facilities that we expect to open during that time frame So we should have a fairly good handle on this, but some of the facilities that are expected to open in 2023, particularly if they're expected to open later in 2023, those could potentially slip maybe into 2024. And in 2024, the supplemental mandate goes away, and you get a much smaller gap between ethanol production and the ethanol mandate. And maybe that's when biodiesel margins start to go to levels that really do start to force rationalization of biodiesel capacity. That's kind of what we're expecting, and how we're forecasting biodiesel capacity. For our RIN forecast, we didn't make a lot of adjustments to our forecast. It still sort of features the same themes, which are one, that prices are likely to remain really well supported and at or close to the peak that we saw last year, and two, that the spread between the D4 and the D6 RIN is likely to continue to narrow from currently it's around $15, I think, maybe a little bit less, and we expect it to get probably as close to parity as it will ever get this in the fourth quarter of this year. Whatever that difference is in the fourth quarter, I think that's probably will become the minimum spread that we use going forward whenever we are worried about the blend wall and trying to predict the spread in the future. I think we probably will rely on the spread in December is a reflection of basically the tightest that the closest that the two can actually get in practice. Outside of that, I think I think the forecast adjusted maybe a little bit lower this week, but not really substantially. For our LCFS credit price forecast, that we actually flattened out a little bit this week. Prices seem to, and again, this will be the fourth time I think I've said this. I think I said it at 150 and then at 115 and then at 100 and now at 80. It seems like prices want to stabilize around here at this level. And so we flattened out our forecast a little bit. We've got it coming down a little bit more for the fourth quarter and then kind of coming back to this level and kind of at this level forward for the foreseeable future. We still don't have a great sense of whether the LCFS price is going to head lower or it's going to finally stabilize and start to move higher. I know that CARB has released something that may indicate that they are a little bit more willing to do something about LCFS credit prices. I'll admit I haven't read the document that was released in any great detail, but I think that the potential for them to come in and make some adjustments is probably higher than I have been thinking it has been. Once I really get through the document, I'll talk about it when we go through our LCFS credit price forecast, but I did want to bring it up and kind of highlight the fact that that if that were to happen, obviously the forecast could look substantially different, but it's hard to know exactly right now how I think that would impact the forecast, other than to say that I would think that it would mean that prices our forecast probably would adjust higher. I don't have a sense of whether that means that it would adjust back to $200 a metric ton, or whether it would adjust back to sort of $115 or $150 a metric ton. Either way, this week for the first time in a while, our forecast kind of flattened out and quit moving lower. It may be that prices resume their downward march next week, and I come back next week and tell you that, okay, we've readjusted back to our old forecast that's lower and lower, but we'll kind of have to see, unfortunately. All right, with that, there are a couple of questions. How tight are the controls on passing virgin palm oil off as UCO to get access to approved pathways? Are there any restrictions on used palm oil based UCO? I'm not aware of any restrictions on used palm oil based UCO or restrictions on UCO sources, sort of the pre-UCO when it's not used, it's just whatever kind of cooking oil it is. So I'm not aware of any restrictions, but that's not something that I've looked at before, so I will follow up with you on that one. In terms of the passing palm oil off as UCO, I think what I would say about that is that there have been in the past several, at least, attempts to use various things as UCO, and that part of the market is one because yellow grease and UCO tend to be catch-alls. It's one that people have tried to take advantage of, or tried to stretch the limits of the definition of UCO. I know that that is something that has happened. As far as I know, as long as the vegetable oil meets the specifications for a UCO in terms of FFAs and metals and that kind of thing, as far as I know, then it can qualify. I'm not aware of anyone specifically trying to pass palm oil off as UCO. But again, let me do a little bit of digging, and I will get back to you with a more definitive answer. Again, I would just sort of leave the bottom line right now as because UCO is sort of a catch-all. There have been attempts to stretch the rules for what qualifies as UCO. They may have tightened up the controls over the years since there have been those attempts, but I'm not aware that there is anything that is, I'm not aware of any sort of overarching regulatory procedure that really clamps down and makes sure that all UCO is actually UCO, again, beyond sort of the qualifications for the specification based on metals and FFAs. I got on the call late. Why has the HOBO spread collapsed so much? The HOBO spread has collapsed because of the really sharp decline in soybean oil, which I think was a function of the decline in palm oil. And so I think to understand why HOBO has moved the way that it has, I think you have to understand why palm oil moved the way that it did. And what you had was essentially you had palm oil pretty much priced for perfection, or you had every bit of bullish news that you could have for palm oil reflected in the price. You had the Indonesian ban was sort of the last thing that really sent palm oil up to its record highs. And then you had the reversal of that ban. And initially after the reversal, you had the Indonesian government issuing export licenses a little bit slower than the market anticipated. And so that helped support palm oil prices a little bit, even after the ban was announced, or the reversal of the ban was announced. In addition, there was this domestic obligation part of the reversal of the ban, which was in place before the ban, but was recrafted a little bit. And so I think that the market was trying to understand exactly what the reversal would mean in terms of the volume of Indonesian palm oil that would be back on the market. And because the government was a little slow in issuing the export licenses, it didn't initially look like the floodgates were going to open and palm oil was going to come out of Indonesia in huge volumes. Then you had the Indonesian government start to increase the pace and really work on issuing those export licenses more quickly. And so you saw Indonesian export volumes jump. And at the same time, you saw an increase in Malaysian palm oil production. So if you remember back to this is June. So if you remember back to May, Malaysian palm oil production declined a little bit from April to May, which typically you would expect palm oil production to rise from April to May because it sort of bottoms in February or March, and then it typically rises month over month until it peaks in September, October, and then starts to decline. And the reason that palm oil production was flat from April to May was because of this ongoing issue with a labor shortage in Malaysia. They were having problems getting enough migrant labor into Malaysia to harvest the palm fruit and get it into production. Well, during the first half of June, you had estimates that suggested that Malaysian palm oil production was going to jump as much as 50% relative to the same period in May. So a 50% increase during the first 15 days of June relative to the first 15 days of May. Of course, that 50% wasn't going to hold up through the end of the month, but it did suggest that that there had been, if not a resolution, at least an improvement in the labor situation in Malaysia, and production was probably, instead of remaining flat or growing more slowly than you would typically expect based on the historical seasonal pattern, that it was going to catch back up and maybe exceed the typical seasonal pattern. And I think that was really the straw that sort of broke the camel's back. That, and you had a decrease, a drop in Chinese vegetable oil prices at the same time, and you've had a slowdown in Malaysian palm oil exports. And so if you look at the monthly palm oil balance sheet, basically went from last month's ending stocks of around 1.5 million tons to a scenario where I could take the ending stocks for June up to almost 2 million tons, which is a huge month over month change. You typically don't see really big changes like that. Now that's at the extremes, and that's not what I expect. But it highlights how sort of quickly the supply and demand outlook for Malaysian palm oil changed. And so you saw Malaysian palm oil drop from basically around 7,000 ringgit per ton to about 5,000 ringgit per ton over a very short span. That drove the spread between palm oil and soybean oil up to about 20 cents a pound, which is pretty close to the maximum level that that spread can be. Last summer, I think it hit 30 cents a pound, but as you get to 20 cents a pound, it becomes very tough for soybean oil to ignore whatever's going on in the palm oil market. And so as the palm oil market dropped, it sort of dragged soybean oil along with it. At the same time, again, you had a decline in energy prices, and you had growing concerns about global recession. And so all of those factors kind of combined to really take the HOBO spread sharply lower. In addition, on the HO part of the HOBO spread, you've had this this diesel shortage, and heating oils very close to diesel, which is why we use it in the HOBO spread. And that has kept diesel prices and I guess what I would say more broadly is product prices elevated relative to crude oil prices. So if you track the crack spread at all, the crack spread has risen to 50 or 60 cents, which is just something that is kind of unheard of in the energy industry. So you had this kind of perfect storm of palm oil prices just dropping off a cliff, dragging soybean oil prices lower at a time when, yes, energy prices were coming down, but because of the shortage, the decline in the heating oil part of HOBO wasn't as significant as the decline in broader energy prices. And so that also contributed to a reduction in the HOBO spread. Now, the HOBO spread is an indicator of renewable fuel production, biomass-based diesel production, but it's not that great, especially for renewable diesel, given the fact that we're building out new renewable diesel plants. And so that relationship, which was really loose to begin with, has really broken down. It still holds fairly well for biomass-based diesel or biodiesel production. And this collapse means that you probably will see greater biodiesel production relative to sort of the 5-year average for any given month in June than you would have expected sort of several months ago. I think we'll see when the EIA data comes out next month, but my expectation is that biodiesel production probably is going to be relatively well supported here, and the margin data that we track again sort of also supports that idea. But that's why the HOBO spread collapsed as much as it did. All right, with that, if there are no other questions, then I am going to wrap it up. Thanks everybody for attending, as always. Have a great week. Next week, we are not going to have a webinar because Monday is the July 4th holiday, and I am actually going to be off next week. So I'm going to publish the report, but we won't meet next week. So I will see you all in 2 weeks. Everybody have a great holiday.